Hi guys, the last few classes we discussed about price level changes, that is inflation and deflation, its importance, its impacts on Indian economy and the measures taken to control these price level changes, inflation and deflation. Continuing to that, now we are continuing the same topic, that is measures taken to control inflation and deflation by another agency called RBI. We know in India only two agencies have the power or authority to control these price level changes, that is Government of India, that is central government, and the other one is Central Bank of the country, that is RBI. The measures taken by RBI to control these price level changes is popularly known as monetary policy. Under open market operations, RBI will buy and sell debentures of Government of India through treasuries and banks. The question arises in our mind is that by way of buy and sell, how the money flow or how the price level changes controls. During inflation, what RBI will do is that they will sell shares or debentures to the public. By way of sale means by way of sale, automatically by giving the share sale certificates to public, government will collect money from the public, that is from the economy. Government will take over the money from the economy, so automatically the flow of money will be reduced. So by way of reducing the flow of money, we can control inflation. And during the deflation, what Government of India through RBI will do is that RBI will, on behalf of Government of India, RBI will purchase all these debentures. Those debentures which will be sold earlier will be purchased by RBI during this time period. Because during deflation, we know everything will be low or less. There is very less job opportunities, number of job opportunities will be very less, income level will be very less, purchasing power will be very less. So what public requires more money into the economy. What RBI will do is that they will purchase these debentures from the public. By way of purchasing these debentures, RBI will inject more money into the economy. Automatically it will lead to increased job opportunities, increased purchasing power. At the end of the day, it will lead to increased demand for the product also. And the next tool or instrument used by RBI through monetary policy to control these price level changes is known as CRR, Cash Reserve Ratio. Those banks which are registered under RBI, Reserve Bank of India Act and Banking Regulation Act, and those comes under the RBI's rules and regulations, needs to follow certain instructions from RBI strictly. One of them is that this is called CRR, that is Cash Reserve Ratio, that all the banks must keep separately, that is with RBI, a certain percentage of their total deposits as money with RBI. For example, I am saying if the CRR rate is 4 right now, then there is an inflation in the economy. So what we need to remove money flow, reduce the money flow from the economy. We need to reduce the money flow from the economy. So automatically RBI what will do is that they will increase the CRR. By way of increasing CRR, total deposits available for total money available for the banks to distribute to the public will reduce. So that automatically reflect in the Indian economy. So by way of that, we can reduce the flow of money into the economy, we can reduce the inflation level in the economy. And during the deflation, just opposite of that we will do. That is, RBI will decrease the rate of CRR. So by that way, banks will get more money for public distribution, that is through loans and advances and all. So that way we can inject more money into the economy. Repo is the rate at which banks will get loans and advances from RBI. Whenever banks require money for a short period, short term, banks can get loans from RBI. RBI's customers are these banks only. Loans taken by banks from RBI, for that whatever the interest they are paying, that is known as repo. If RBI increases repo rate, means the loans taken by banks will become more costlier. So because of this, banks will compel to fund public with a higher rate. Then only they will be able to recover their investment or their own credit and all. So automatically the loans taken by public will become very costlier or more costlier than earlier. So public will rethink, because in the situation during the inflation time, they will rethink whether we need to do more business, we need to expand, whether it's required to expand the business or not. because of the higher rate from the banks. So by that way we can reduce the flow of money from the economy. The interest provided by RBI for the deposit given by other banks in the country is known as reverse repo rate. During deflation, what RBI will do is that they will reduce the reverse repo rate. So it will encourage or compel the banks to spend more money with the public. So that way we can inject more money into the public. These are the major or most important weapons used by Reserve Bank of India to control the price level changes, or that is inflation or deflation, and it is popularly known as monetary policy. I hope everyone is clear with whatever we discussed today. If you have any doubts, please mention it in the comment section of the video.